Good afternoon, everyone, and welcome to the first event in our series of Professional Advisors Working Lunches for 2023, today brought to you courtesy of our partner, Baillie Gifford. I'm Hope Williams-Smith, Editor of Professional Advisor, and I will be your host for the next hour. Before we get going with today's session, let me quickly run you through the usual housekeeping. Your microphones and cameras are currently switched off, and we'd be most grateful if you could keep them that way. That would just ensure there's no background noise so the speakers can be heard nice and clearly. I should also inform you that this session is being recorded and we will send you a link of the recording by tomorrow. Do feel free to share this with your colleagues. Now, as usual, today's working lunch will qualify for 1 hour of CPD and we'll be sending your proof of attendance along with the link to the recording of the session, and that will arrive in your inboxes tomorrow. Today, I'm delighted to be joined by Baillie Gifford's Seb Petit, who is Client Director within the Baillie Gifford Investment Team. Over the next hour, I'll be talking to Seb about the challenges for income investors in the global climate, Baillie Gifford's views on the long-term future for the sector, and the philosophy behind it. Do feel free to put any and all of your questions to Seb using the chat function, which you'll find in the bottom right-hand corner of your screen. Alternatively, if you wish to remain anonymous, then simply select my name from the drop-down list in the chat box before you type your message so that only I can see it. So just before I hand over to Seb, let me quickly run you through our learning objectives for today. So by the end of this session, delegates will understand the importance of a growth mindset in managing for long-term income, understand the building blocks of resilience in an equity income portfolio, and understand how a long-term investment horizon affects the approach to sustainability and engagement. So that is CPD covered, and we'll get started with an introduction from Seb.
Thank you very much, Hope, and good afternoon, everyone, and welcome to this webinar. So I'm Seb Petit. I joined Baillie Gifford at the end of 2020 as a client director, and I'm attached to the sort of the global income growth strategy, which we will be talking about today, with a particular focus on our responsible variant, the responsible global equity income, which was launched in December 2018. But we thought we'd start today's session with a poll, because obviously we had, last year sort of a very difficult year for many asset classes, which was, very unusual. Bonds and equities, declined in sort of in to levels that we hadn't seen in a long time. So I was interested in hearing from you about the impact of rising interest rates and which asset class that was leading you to invest into, considering the new environment, and certainly this interest rate reset has been something obviously very unexpected, and quite a big change, leading to a sea change in terms of monetary policy and central banks now rushing towards rising interest rates. So I'm very curious as to what you are doing in that more difficult environment. So I'll just wait maybe for the results to come out, just to give a few comments.
Thanks so much, Seb. Just while we wait on those results, just a quick reminder for a couple of people, if you could please turn your cameras off, that would be greatly appreciated. Now we should have the results of the poll coming up on the screen, so I will let Seb talk us through those.
Thank you, Hope. Well, that's interesting. So people haven't given up on equities, which is very interesting, particularly growth equities. And obviously last year was quite a catastrophic year for growth equities. So interesting to see that people are starting to get more interested again, and fixed income. Interestingly, I was expecting maybe a slightly higher number considering the more attractive yields that we are seeing now. So that's very interesting. Thank you.
Thanks, Seb. That's certainly an interesting start, but I'm really interested to know if you think the rise in interest rates makes equity income more or less attractive.
Yeah, so I think there are two ways to look at this, after this interest rate reset. One is to look at, global equity income versus fixed income and versus sort of bond yields. And clearly there is more competition essentially from, bond funds and interest rate or fixed income based sort of asset classes. So there's no doubt there that it should make it harder for equity income. But we shouldn't forget that, we obviously are talking about fixed income. And so it depends quite a bit on, what people expect in terms of inflation and how long people expect for that inflation, which we are seeing at elevated rates now, to be sustained. Because if you expect inflation to be quite elevated for a while, then the erosion of the fixed income makes those bond funds less attractive. The other aspect is within global equity markets, typically global equity income funds have a value bias. And in that environment, typically, value stocks tend to have, high dividend yield, and some of them, are often correlated with interest rates, which means that, and that's why the value style did so much better last year, and particularly the energy stocks. And in that context, global equity income compared to other equity strategies should be more attractive. Obviously, we had, from 2009 to 2021, we had 12 years of rising markets, strongly rising markets driven by, growth stocks in particular. And in that environment, the value of the dividend was not, very obvious. Because markets were going up strongly. Now last year, obviously, equity markets had a big fall, and in that environment, suddenly the value of the dividend and the value of the income rises. So again, depending on your outlook for global equity markets, we should see the value of equity income rise again. And certainly we've seen in our sort of client base, we've seen a bit more interest into our strategy compared to 2 years ago. So the next poll we wanted to run was, focusing now on these global equity income funds that I just mentioned. I was interested to hear your views as to what you are looking for in an equity income fund. So are you more interested in the starting yield? Is the resilient income what matters to you and your clients? Is growing income a factor? Or are you just looking at total return like some of our clients do, and not that interested in income side of things, but like the fact that the dividend discipline leads us to invest in a certain type of companies, which gives over the long run, a strong total return, just the steady compounders. So, again, curious to see your views on this when choosing an equity income fund. Total return, that's interesting. So the starting yield is 1%. That is great to hear, because we don't like starting yield either. Total return versus resilient income, that's interesting. So even looking at equity income fund, it sounds like most of you do look at the total return, which again chimes in with our approach to income investing. So that's interesting.
Thanks, Seb. I think given everything you've just spoken about, what would you say differentiates you guys as an income manager?
Thank you, Hope. And to answer that question, I will just bring up a slide and share my screen because it makes it easier to explain. And here we show the key features of the strategy I'm talking about today. And really, if I had to sum it up, it would just be to read the words in blue at the top of the boxes here. So what we're looking for are, growth companies which have sustainable business models, resilient dividends, And we tend to hold them for the long term with the average holding period of 8 years. And so I'll just unpack that a little bit because it's quite a lot to take in. So looking at the growth first, and for that I will go on to that slide. And I think the key for us is to focus on the long-term income growth rather than the short-term yield, which is interesting because according to the poll, this is also something you seem to be all doing. But essentially for us, the long-term income growth is much more relevant for an income investor than the starting yield, because starting yield is the next 12-month dividend essentially. Whereas if you look at the long-term income growth, the value of a company is the value of all the future cash flows. So it's very important to understand those future cash flows and how they might evolve over time. And to illustrate that sort of approach and philosophy, we have put this slide together, which is essentially showing two different companies, Microsoft in light blue and RVE in gray, and looking at the income produced by these two companies over the last 12 years or 11 years, and what has been the difference. So if you look at the gray bars first, and RVE, so RVE is a German utility company producing electricity. And back in 2011, the dividend yield was 7.4%. So RV was really a dream income stock, 7% yield, very predictable business, German company, utility, really like a dream for an income investor. Unfortunately, that dividend was unsustainable. And the reason is they had to pivot their business away from coal and nuclear energy to generate electricity, and that required enormous amounts of cash flows. So they had to reallocate some of the cash flows away from the dividend into sort of transitioning their business essentially. So they cut the dividend quickly and then suspended it altogether in 2016 and 17. If you look at Microsoft, in contrast, the starting yield was not that attractive, 2.3%. Which was below market yield at the time. But what we could see, and we have invested in Microsoft since 2010, what we could see was, earnings growth, for the long term, which would drive dividend growth. And this is what happened. And if you look at the income over the year, it has grown by about 10% every year over the following sort of 11 years. So much so that on 100 invested in 2011, now the stock is paying a 7% yield. And if you look at the table at the bottom of the slide, total income received, from Microsoft was about 55, compared to 26 for RV, so more than twice the income, despite a starting yield which was a third that of RV. Not to mention the capital returns, which have been, very, very different for the two companies. And to us, this is really the essence of what we're trying to do. And we're trying to find the Microsofts of the future rather than, trying to find, the high yield that will, be, very pleasant and comfortable for the next, maybe 1 to 3 years, but typically is a sign that either a company is overpaying, as is the case with RVE, as was the case with RVE, or a company that has run out of growth opportunities and so can afford to pay all the cash generated in dividends. But that also means that you shouldn't expect that dividend to grow over time because there's no growth opportunities. So that's the first key differentiator, I think. And, as you would expect, we belong to Baillie Gifford, a growth house, and obviously we're managing for income with the Baillie Gifford mindset, if you like, and a growth mindset. The second, I think, quite important differentiator is that focus on the resilience of the dividends. And is this something the team spends quite a lot of time on to try and understand how our companies in past recessions or challenging economic environments have behaved, both in terms of their business model, the cash flow generated, but also in terms of the board's decisions on dividends. And did they cut, did they reduce the dividend at the time to protect the balance sheet, for instance, or did they continue to pay a dividend through thick and thin? And we think And this is the kind of work, this work on resilience is not paying off in most years, because most years the economic environment is, favorable, earnings grow, and so that resilience is not tested. But we know that over the next 10 years, there will be another crisis, there will be another shock to these companies. And so we want to be sure that when that happens, they are, well prepared. And I think, for us, we've been talking about that for a long time, but as I said, from sort of 2010 to 2020, it hadn't really been tested. And then the pandemic happened. And for us, what was interesting is that, 9 out of the top 10 holdings at the beginning of the year 2020 managed to, maintain or raise their dividend. So much so that the strategy as a whole distributed slightly more income in 2020 versus 2019. And that was in a year when, obviously, because of the pandemic, global income was down about 15%. So to us, resilience of the companies is very important and something which we believe differentiates us from many of our peers. And the last one is the long-term approach. So as I say, we tend to hold stocks on average for 8 years. Which is very different from the average asset manager out there, which typically tends to hold companies for 12 to 18 months. And we think that introduces some very interesting sort of elements. One is, our belief is that in the long term, the market is less efficient. The sell side brokers are very incentivized on trading. They are very focused on the next, 1 year to 18 months. Companies guide, and there's a lot of analysis done on the next, 1 to 3 years for companies' earnings, etc. There's a lot less work being done over the next 5 to 10 years for each company, and that means there's more opportunity to find mispriced companies and mispriced compounders in when we look at that very long term. So, for instance, we have in the team an investigative researcher. Hattie Oliver, whose sole role is to delve into a company's culture, delve into really understanding a company by talking to employees, past employees, clients, competitors, just to try and understand how the culture is in the company. Is it changing? Is it not, etc. Because often for the very long-term successful companies, culture is an important part of that. Now, this is the kind of work that if you are going to invest for the next 18 months, it's not worth doing. First of all, it takes a lot of time. Second of all, the effect will only be seen over, many years, not in the next 18 months. And so for us, it makes sense because we are long-term investors. For many people, they won't do it, which is what creates this sort of opportunity. The other important element when thinking about the long term is the fact that over the long term, the fundamentals trump the valuation multiples. So you could have in the middle, big changes in the valuation multiples, but if you look at the stock return over 10 years, typically what is much more important is the evolution of the earnings and the dividends. And so that means that instead of spending the time, agonizing over whether, you should pay 15 or 18 times earnings for a company, you can spend a lot of this time on the fundamentals and the future prospects for the earnings. And we think that is adding more value over the long term. And finally, the important element of the long term is also the fact that it puts ESG considerations at the core of the analysis. So for us, ESG is not a nice, marketing overlay or not a nice, nice to have kind of thing. Because if we want our companies to be, thriving in 5 to 10 years, if we want them to be, successful with their customers, there's no doubt that they need to start adapting and facing the ESG challenges that they do. They need to adapt their business to be able to survive and thrive. And so for us, there's no tension, if you like, between investments required in ESG, which are, short-term investments can be costly, and the results of which will only be seen in 5 to 10 years. Again, if you're an average investor, you won't see the results. You will only see the cost in the short term. And so for you, as an incentive, there's a lot less incentive as a short-term manager to push the companies to do the right thing to make sure they prepare the business for the future. For us, we have very different conversations with the management of those companies because the interests are aligned. We are aligned with long-term, focus and the fact that they need to make changes if they want to be relevant in 10 years' time. So that's to the long-term approach, which is enabled by the fact that we belong to a private partnership, is, in our view, one of the main, competitive advantages that we have, and we think differentiates us from our peers. I'll stop there. I spent a lot of time on the time, but maybe I'll stop there.
That's fine. It's better to have a thorough answer than a short one. I'm interested to know, based off that, has the focus on growth meant higher interest rates have affected you more than, say, a traditional income strategy?
Yes. So there's no doubt that we have been more affected. So when I say growth companies, I'm really thinking about companies that can deliver sort of 10 to 15% earnings growth, but for a very long period of time. This is the kind of companies that we look for. And for those, the value, a lot of the value is in the later years. And so obviously when rates rise and the discount rates rise, the value of these companies get affected. So to give you an example, Novo Nordisk, the Danish pharmaceutical company, very a leader in diabetes treatment, and that is very strong and very good business. But a lot of the value is in the obesity market, which they launched a drug for last year in the US, and which is an opportunity and a market over time, which could potentially be 10 times the market of diabetes. So a lot of the value for Novo Nordisk is in those latter years where the obesity market will be very significant. So for that company, the fact that the value is going to have to be discounted at higher rates is obviously has had an effect. The other element, as you were mentioning, is compared to our peers in the global equity income sector, as I said, there tend to be a value bias, which comes from the fact that some managers tend to look for yield and have a minimum yield requirement, before investing, and that tends to lead them to sort of the value stocks. And so in a year when value outperformed the growth style by more than 20%, like 2022, obviously we were affected. Now, in terms of performance, the fund still outperformed its benchmark, the MSCI ACWI, but it is fair to say that compared to our traditional income peers, we have lagged a bit. Now, we think it's a short-term issue. We think of the long term, these sort of high-yielding stocks, as I was alluding to earlier, these high-yielding stocks, we almost see them as fixed income because, as I say, they don't have growth opportunities. So the opportunity for that income to grow is about zero, which means they are fixed income, which means that, again, that will be eroded by inflation over the long run, which is why, we haven't suddenly become sort of value investors.
Thanks, Seb. Just to close off this section with one last question, where do you currently find opportunities? So, for example, are you tempted to buy into energy stocks or banks, for example?
So, yeah, so these are, typical, sort of value sectors, and we're not tempted at all, partly for the reasons that I explained, but also because, again, if we look at the next 5 to 10 years, oil companies are in big trouble. And there was obviously a bounce last year and a spike in energy prices, which is a boon, for oil companies. But it also means that the energy transition will be accelerated. And you see, the EU scrambling to create and find alternatives to the Russian energy. And so there is a short-term, positive impact on these companies, but it also accelerates, in our view, it also accelerates the decline in the long term for these kind of companies. So we're definitely not attracted to that. Same with banks, and the similarity between these two sectors, if you like, is also the fact that these are sectors which are essentially commodity sectors, and for banks it's really hard to differentiate themselves, and the stocks tend to move all together with the interest rate essentially. And same for the energy companies, whether you're a good energy company or bad energy company, if the oil price doubles, you will do well. And so as fundamental stock pickers, for us, these sectors tend to be a bit frustrating because they're driven by these big macro events. And it's very difficult to differentiate between different players in the same industry, and so the value of what we can add is not very high, and so we tend to shy away from these sectors. There's also a big issue with these two sectors in particular, is the fact that the resilience of their business model is not very high, and so they tend to be very cyclical, and in a downturn would do very badly. So at the moment, for instance, for the banks, we are in this sort of nice period for them, which is higher interest rates charged to the clients, but not high enough that it triggers a recession and triggers default on the loans. But there's no doubt that if a recession happens, that will happen, and so the bank stocks will suffer. So again, quite cyclical businesses and not very dependable dividends in the long run. So where we find opportunities at the moment for us is more, looking at companies that have, quality growth companies that have been, derated as markets fell last year. And so we're looking a lot at companies that we have done research on in the past and have never pulled the trigger, usually because valuation was too demanding. And then last year was an opportunity for us to revisit these companies and reinvest in some of those because the valuation had become more palatable, if you like. So one example is L'Oreal, the French cosmetics company that we bought in Q2 last year. So again, this is a company we've admired and followed for a long time, and really have wanted to be shareholders in for a long time, but it was always a bit too demanding in terms of valuation. And then last year they had a bad quarter, valuation came down, and we were able to invest. Again, we're not trying to time the market. This is not our sort of edge. But when we see an opportunity to invest in a great long-term compounder at attractive valuation, we will do it, and that's what we did last year with L'Oreal, for instance. So I think maybe we can move on to the next poll, because there's this debate about inflation risks, talking more sort of short-term inflation risks facing your clients. And I was wondering, and I was keen to hear your views on how you respond to that. Because one strategy is to move assets into high-yielding bonds, but we've seen earlier that it wasn't the majority case. But are you tempted to buy companies or the more value funds or properties? So I was curious to hear again, because this is a particular time in history where last year was an unusually high correlation between bond and equity markets, and both declining quite a lot, particularly in US dollars. And so I'm curious to see whether that has had an effect on the way you look at the markets. And the results, no actions. Okay, so that's interesting. So no oil companies, high yielding bonds a little bit, and then more value funds, which is interesting, but mostly not taking any action. So that's interesting.
I think, Seb, it's fair to say that inflation is a really major concern at the moment. So could you explain a little bit more about how your portfolio has been impacted?
Yes, and maybe for that I will share my screen again and just show the portfolio that we run, because people can see the type of names that we invest in, and that might help explain, the way we look at things. One thing is clear, and which has become very important, is pricing power. Because in inflation, your costs are rising, and if you have the pricing power and you are able to raise your prices, then you can maintain your margins and you can actually show, quite significant growth. Now, pricing power is something that, a lot of companies are talking about, but it's always difficult to prove for them to prove, and we'll see. Over the next few months, we'll see clearly who has pricing power and who hasn't. For us, it's been fascinating to see, for instance, the staple companies, and they some of them have pricing power, and we saw that with PepsiCo, which is a company we own in the portfolio. So, for instance, in Q3 last year, they published revenue growth of 16%, most of which was pricing. So that's interesting, because staples are typically products that you buy out of habit. They are relatively low cost, and so if you think of a PepsiCo, if you think of a Nestle, people who like Kit Kats will still buy the Kit Kats if it's 80p versus 70p a year before, and so because they won't see the effects, not that significant. And so we have seen, companies like Nestle, companies like PepsiCo, able to produce, earnings growth, which we hadn't seen in a very long time, thanks to the ability they have to raise prices. Now, when we say raise prices, it's important to understand that they're not raising prices across the board on all their products. What they are trying to do in those environments is to manage their portfolio and try to either, play with the size a bit, the shrinkflation that we've all heard about, but they also try to manage the portfolio and, emphasize their advertising efforts on, products which are maybe, higher priced, typically more innovative. So PepsiCo, for instance, has been pushing a lot and putting a lot of emphasis on their, new products, which are, less salty or less sugar in the snacks division. And so that is what has helped them at a firm level, show pricing increase, which has driven that revenue growth. So pricing power is very important. And again, something we've been looking at for all our companies over the past 18 months. It could also be a company like TSMC, the chip manufacturer, Taiwanese chip manufacturer, where they have a quasi-monopoly on the next generation chips. So again, they're in a much better position to increase prices on these if demand is strong than someone doing memory chips, which are a commodity. And so the focus on growth companies, we believe, is also what allows us to find those companies that have the pricing power. The other important element and the other characteristic of a growth company is typically they have high gross margin, because their products are in demand and they tend to add value, at least the companies in our portfolio. And for a company with a high gross margin, it's easier to recoup the big increase in input costs by raising the prices a little bit, and offset that rising input cost on their margins. And that's what we've seen at a lot of companies. We've seen a temporary hit to the margin as input costs rose quite a lot last year, but they have been able to raise prices, which means the margins are going to be restored. And actually, as I was saying, the top line growth has been driven by inflation and faster growth. So that's been very interesting. Again, the pricing power is something which we believe a lot of value stocks do not have, because if you sell oil, you don't have any pricing power. There's a price is the same for everyone. And so very important to own growth companies which add value, and which is what we're trying to do.
Fantastic. That's a really good explanation there for us to work through. So moving beyond inflation a little bit now, how challenging would you say it is to manage a bottom-up portfolio in times of large macro trends and difficult geopolitical tensions?
Yes, so it's not easy. And obviously, something we have to, consider. I think, again, we believe our edge is not in forecasting the oil price or where interest rates are going, because first of all, that's very difficult. Second of all, it's very short term in nature. So we think our time is better spent, trying to understand the fundamentals of a company in the long run. It's not to say we're not dismissing the fact that the macro environment will have an impact on our companies. We're well aware of that, but we better spend the time understanding how they would cope in such and such environment, and are there still interesting investments in those different environments, than, as I say, trying to forecast things that are notoriously unpredictable. Same with the geopolitical tensions. China last year was a big issue. We own about 5% of the portfolio is invested in Chinese stocks, and obviously there was a big slowdown. There were tensions with the US in certain sectors, and so the result is that all Chinese stocks got derated quite dramatically. Now, again, we try to think long term, and we try to look at these companies we own in China. So we own, for instance, the leading sportswear manufacturer. And for these company, for that company, Anta Sports, has anything changed over the last year that would jeopardize, if you like, the future, earnings and dividend growth that we expect? And we came to the conclusion that it hadn't. So yes, there was an impact in 2022, but the long-term prospect hadn't changed. So we remained invested. And then obviously the last quarter of the year saw a massive rebound in the Chinese market, which was up about 50%. So, again, we know we're not very good at trading, and we'd rather spend the time, over the long-term prospects. And so managing in a more volatile, macro-driven environments is more difficult, in the sense that you have to accept that volatility, and it's it can be quite difficult, but we try to stay focused on the long term and see through it, but it definitely is more difficult.
Bearing all that in mind, what is your approach then to buying and selling names in these volatile times?
So yeah, so it comes back to the point of the focus on the long term, trying to understand the fundamental value of a company, and then the market gives you the price, and that price, in times of volatility, changes quite a lot, and this is what we saw last year. And coming back to this example of L'Oreal I gave, this is a company we sort of had an idea of how much we were willing to pay for, where we thought it was good value, but the price had always been too high for that. Then the volatility of last year is what allowed us to invest in that company at more attractive valuation. We did the same with Intuit, a US software company. Great business, two very strong products in the US, which they are using as a foundation to try and become the sort of financial hub for their clients, which are mostly SMEs, or for the consumer. So again, a company we had done quite a lot of work on, we had followed for a long time and liked for a long time, but just couldn't bring ourselves to buy it on valuation ground. And again, the volatility of last year is what allowed us to invest in that company at more attractive prices. So we're trying to use the volatility to do this kind of things, and we try not to be too swayed by the sharp moves in the market, because again, our edge and our strength is not in trading for the next 3 months. So I think there's another poll coming, which may be changing tack a little bit, was about ESG, because we've heard a lot about ESG, and I was interested in hear your view on ESG. There's a lot of greenwashing. Do you think it's critical? Is it going away? So that's why we had this poll. I'm curious to see the results. So the results are in. Critical to investment, tired of greenwashing, and it's a fad. Okay, that's interesting. So I definitely think it's not a fad. And I do think it is critical to investment, but there's also a lot of greenwashing. And I think that's something we have seen over the last few years. But my impression is that clients are, becoming much more aware of greenwashing. They are becoming, much more discerning in what they hear from companies. So that's interesting.
Thanks so much for that, Seb. We've got quite a few questions coming in now for the audience, which is really great to see. Please do get them in if there's anything that you want to ask. So to start us off, one of the questions asked about the portfolio. They say it looks heavily weighted in US equities, and they want to know if the view is still that there is that value in North America over the next few years.
Thank you. So that's an interesting point, because we are indeed about 40% of the portfolio is in US equities, but it's very underweight compared to our benchmark, which is the MSCI ACWI, which has about 65% of US stocks. So in fact, in terms of relative performance over the last few years, because the global markets were driven by US market, in particular by US non-dividend paying growth companies, it has been a big headwind for our strategy. But we have been able to deliver, performance above benchmark thanks to, good stock picking, but it has been a massive headwind. Now, when we look at the sort of universe of dividend paying companies, it's about 5,000 companies in the world. About 1,000 of them in the US. So there are clearly a lot of US businesses which have very well established business models, still growing, and and we see that continuing for many years to come. And so we would want to hold on to these businesses, like Microsoft, like Procter and Gamble, like National Instruments, etc. But what's interesting also is that, in terms of when you look at these companies, I think, or when you look at the portfolio, we think it's more relevant to look at the geographic exposure, if you like. And when you look at that, our exposure to the US economy in terms of revenue exposure for the companies in the portfolio, it's about 50%, which is not far from the benchmark. So again, there's a place of listing which shows quite a lot of US companies, but their business is quite international. So in terms of sort of exposure, we are broadly speaking, quite a big chunk in North America, but there is then the rest is equally split between Asia and Europe.
Fantastic. Thanks for that answer. Let's move it a little bit back towards ESG. I think a really key question for our audience today is about how advisors can determine which asset manager is actually taking sustainability seriously. So looking for your views there.
Thank you. So I think, to me, one very important element is the long-term investment horizon, or the investment horizon in general. So again, because there is a tension between companies needing to do investments today to prepare the business for the future, and again, investments which will not pay off for many years, and so it is an investment. It is a direct hit to earnings and capex today, which, if you are an income investor and if you worry about the yield and you want your dividend to grow, is something that, if you are going to invest in a stock for the next 18 months, you don't want the company to do that. But if you are going to be invested for the long term, you have to push the company to do that, and your interests are aligned with that company. So to give you a very simple example, Nestle in 2020, found operational efficiencies, to the tune of about 3 billion Swiss franc. If you're an average income manager, you want that operational efficiency to drop down the bottom line, down to the profits and potentially a higher dividend that year. When we spoke to Nestlé, we said, look, you need to change your business, you need to adapt your business, because maybe in 5 years' time nobody will want to buy anything packaged in plastic, for instance. So we'd rather you reinvested that business into initiatives to prepare, those savings into initiatives to prepare for the future, rather than give us a 2% increase in the dividend this year, which is not what we're buying you for. And I think any manager that is serious about ESG, should be able to show that it matters to them and the interests are aligned, because they are long-term investors. And so I think that's quite important. The other thing is, there's a lot of greenwashing, there's a lot of talk, but a lot of people are delegating their ESG function to MSCI or Sustainalytics, using their ratings and using a minimum ratings. We think that, these ratings are, uneven at best, and, can be, misleading. There are inconsistencies between the two rating agencies. So we think we have a proprietary framework. We have our own way of scoring companies, and we look at it slightly differently. And we look at, forward rather than backward, and we don't focus only on, CO2 emission, which is what, MSCI tends to do. So if you look, we own a lithium miner, for instance, called Albemarle, and, MSCI rated pretty poorly because, their production, their mining of lithium emits quite a lot of CO2. Now, when we look at it, we see a company, yes, the impact of their operations is quite high, but the impact of their product is very, very positive and is absolute necessity for the energy transition. And so when we look at Albemarle, we can differentiate between the two aspects, and then we have to discuss, how ambitious is the company to improve on their operations, and how much trust do we have in the management that they will, make the necessary changes. So that's the way we look at ESG. And you can tell by speaking to managers, typically you can tell, which one is doing that kind of deep analysis and deep work versus the one, delegating to MSCI rating, or, with a turnover of 80%, which means there is no incentive for them to push companies to do the right thing.
That makes a lot of sense. So thank you for your explanation. That's really helpful, I'm sure, for many people that are listening in. And we've got a really, really good question here to wrap things up. So one of our listeners wants to know what you and also Baillie Gifford have learnt from the conditions in 2022, and what would you have changed within your own strategy, if anything?
So here, yes, I mean, obviously, 2022 was a difficult year for Baillie Gifford. I think humbling was the word used in the FT the other day. And clearly within Baillie Gifford, there is a range of growth strategies. So if you like, our strategy is towards the core end of the market, the more the total return. We look for the steady compounders. We look for sort of 10 to 15% EPS, earnings per share growth, as I mentioned earlier. Some of our colleagues are much further away on the growth scale and looking for, the disruptors of tomorrow, the very, the companies where, the payoff could be, very, very substantial, but where the risk is also, high, and they are, aware of the fact that, the volatility will affect those portfolio much more. So I think what we learned as a firm is to, stay focused on the fundamentals, stay focused on the fundamentals in the long run, but also understand, what is the market telling us in terms of the valuation. And so I think it's been, the last year has been, there has been a lot of work and a lot of analysis by our colleagues to try and see what could we have done, at the end of 2021 to maybe, take some profits on some of these great companies where the boom given by the pandemic was, a bit more of the value than we thought at the time. So that's been one reflection. But the other aspect, which is interesting, is that there is actually a view that the current shakeup in the funding markets with interest rates going up will also mean that the markets and investors should be able to see which companies are going to thrive and which companies relied a lot on cheap funding to survive. And so there is a lot of excitement at the moment within Baillie Gifford, because there seems to be a lot of companies which we know very well, where we feel that the fundamentals in the long term are very solid, where actually the operational performance has been very strong, but because the market was so negative on growth stocks, it derated everything indiscriminately. And we think that that is offering us, and I'm thinking here of the more growthy managers within Baillie Gifford. They are very excited to have the opportunity to buy some fantastic businesses at very, very attractive prices. Again, for us, it's been less of a volatile time. So we didn't have an amazing 2021, but we had a good 2022. So we haven't seen the extreme volatility that our colleagues have. But certainly for us, the lesson has been that over the past 3 years, we have a strategy which aims to deliver a dependable, resilient income and to grow it in real terms over the long term. The last 3 years, we had the pandemic testing the resilience. And as I said, we managed to increase the distribution. And we had, a high inflation year last year, and we expect income for this year to grow, about 9.5%. So very slightly below the UK CPI number of about 10%. But over the last 3 years, we've kept up with inflation. So we feel that, we have been very thoroughly tested on our two main objectives, and we feel that we have passed this test. So we are very confident. We are actually quite excited. Again, coming back to this point about, the higher interest rates, meaning companies with debt to equity of 50%, which is the average in the market, compared to our companies, which have about 20% debt to equity on average. When these companies need to refinance, again, we will distinguish between the better businesses from those that, have relied for so long on low interest rates. And so our companies, from what we've looked at in the past, tend to widen the competitive gap with their peers and competitors in more difficult times, because at a time when their competitors have to protect their balance sheet, potentially do a massively dilutive rights issue to shore up their balance sheet, our companies have very strong balance sheet and very strong underlying cash flows. And so in a pandemic, or for instance in a recession, if it was to happen, we expect them to continue investing in the business at a time when their competitors will have to retrench, which means that coming out of that difficult time, they should be in a stronger position for the future. And that's what makes us quite excited about the next few years.
Well, thank you, Seb. That was a really fascinating presentation, and thank you for your insights to all the questions as well. Now, before we wrap up, let's just take a quick look at those learning objectives. Again, they should be up on the screen for you now. Well, look, it's getting towards 2 o'clock, and that is what we have time for today. So thank you for your questions. Thank you again to Seb for joining me. On that note, if your question didn't get answered, Seb and the Baillie Gifford team will do their best to do so after the event. Now, just before we close up, I should assure you that your CPD will be delivered tomorrow, unless, of course, we can't see who you are. So if your screen is not showing your full name, please do type it into the chat now so that we have a record of your attendance and you can get that CPD. And now to close, let me leave you with a teaser of what's to come from Professional Advisor in this first quarter of 2023. For those of you that like to shake speakers by the hand at live events, our first roadshow of the year will kick off in Harrogate on the 24th of January, where multi-asset and MPS strategies will be on the venue. You'll hear presentations from Orbis, HSBC Asset Management, Morningstar, Prudential and LV. After Harrogate, we'll be going to Warrington on the 25th of January, followed by Birmingham on the 26th. And the week after that, we will be in Bristol on the 1st of February. And our final stop will be in London on the 2nd. For those of you that are in Scotland or Northern Ireland who didn't get to visit our investment roadshow last September, there's another chance to catch up with presentations from Albemarle, HSBC, Orbis, Pictet, Simply Biz and Vanguard when we run the event again online on the 2nd of March. So please look out for your invitation in your email inbox. On the 8th of March, we'll be back with another working lunch with Baillie Gifford, where Client Service Director Fraser Thompson will give us an update on the Baillie Gifford American Fund. Finally, if like so many, you could do with some help getting your business prepared for Consumer Duty, we've teamed up with Sesame Bank Hall to provide you with a comprehensive workshop, which is designed to take you step by step through the process. Over 3 2-hour sessions across 3 days will take you through the 6 elements of the Consumer Duty and provide you with a valuable workbook that is going to help get you there. Details of all of our events and how to register for them can be found on the Professional Advisor website now. So all in all, that is a total of 9 hours of CPD for you in Q1. So that is it for today's session. All that remains is for me to thank Seb once more for his presentation and for answering our questions. But of course, our biggest thanks as ever goes to you, our readers, for your company this lunchtime. I really trust that you found this session helpful and worthwhile. And if you did, perhaps we will see you again at our next event. Goodbye.
Thank you. Goodbye.